Welcome! Have you ever looked at your business finances and had that nagging feeling that you're just not seeing the whole picture? Well, if so, you are definitely in the right place. Today, we're going to dive into the two fundamental ways to look at your money: cash and accrual accounting.
We've all heard that saying, right? Cash is king. And it makes sense. Money in the bank feels like the most important thing. But when it comes to understanding the true financial health of your business, is the cash you have on hand the whole story? Let's find out.
Okay, let's get right into it. The absolute best way to think about this is like having two different lenses for your camera. One gives you a quick snapshot of a single moment, and the other, that one shows you the full movie. So first up, we have the snapshot lens, which is cash basis accounting. It's as simple as it sounds. It's all about what's happening right now. Let's say you do a job for a client today, but they don't pay you until next month. Under cash accounting, that revenue doesn't even exist until that money physically hits your bank account next month. And then there's the full movie lens, accrual basis. This one is all about the economic event itself, not the cash. You record revenue the moment you've earned it, so when the work is done, even if you haven't seen a dime yet. And it works the same way for expenses. You record an expense when you've incurred it, not just when you get around to paying the bill. So you see, the crucial difference here is all about timing. Cash basis is that real-time snapshot of your bank balance. It's focused only on cash moving in and out. Accrual basis, on the other hand, well, it's trying to tell you the complete story, like a movie that captures everything that happened in your business during a specific period. So you might be wondering, why is this full movie approach the standard for most businesses? Why do major regulations, like GAAP in the US and IFRS, the international standard, why do they actually require it? Well, the answer is pretty simple. It tells a much, much more accurate financial story. It all really boils down to two really powerful and honestly very common sense principles. First, you have the revenue recognition principle. Sounds fancy, but all it means is you record revenue when you earn it, not when you get paid. Second, and this is the really clever part, is the matching principle. This says you have to match expenses to the revenue they helped you create and record them in the exact same period. And check this out, because this example makes it crystal clear. Let's say you deliver a huge project in December. Under accrual, you recognize the revenue and the salary expense in December, showing you a clear profit for that month's work. Makes sense, right? But with the cash method, since no money has moved yet, your books for December show zero revenue and zero expenses. It literally looks like you did nothing at all. And this accuracy is exactly why accrual is so important. A misleading cash report could cause you to make some pretty bad decisions. For example, if that big payment from December's work finally arrives in January, your cash report would show a massive profit for January, and you might be tempted to spend big. But the accrual movie would show you the truth. That profit was really from December's hard work. That's the kind of real insight you need for smart budgeting, and it's what banks and investors demand to see. Okay, so accrual is clearly super powerful, but that doesn't mean cash accounting doesn't have its place. So let's take a look at how you choose which lens is right for your situation. What's really interesting here is just how clear the divide is. Cash basis is perfectly fine and honestly a lot easier for individuals, freelancers, and really small businesses. But the moment you become a larger corporation or you go public or, and this is a big one, you hold inventory, well, the rules are clear. You must use the accrual method. But what about all those businesses stuck in the middle? What if you're a small business owner who loves the day-to-day simplicity of the cash method, but you need the accuracy of accrual for your official year-end reports? Well, there is a very common and really practical solution. It's the hybrid approach. For most of the year, you just operate on a cash basis. It's simple, it's easy to manage, and it gives you a real-time pulse on your cash flow. And then at the end of the year, you or your accountant will come in and make a handful of specific adjustments. You'll account for the money you're owed, that's your accounts receivable, and the bills you haven't paid yet, that's accounts payable. These adjustments essentially convert your simple cash records into official, compliant, accrual-based financial statements for the bank or the tax man. All right, we've looked at the snapshot and we've seen the full movie. So what's the big takeaway here? How do we put this all together? It really comes down to this. Cash accounting gives you a simple, easy-to-manage view of your cash flow. It's perfect for small operations. Accrual accounting, on the other hand, gives you that accurate, comprehensive story of your financial performance by matching up revenues and expenses, which is absolutely required for serious reporting and analysis. Choosing the right lens or, knowing how and when to use both is the key to truly understanding where your business stands today and maybe more importantly, where it's headed tomorrow. So the question you should really be asking yourself is, what story are my financials really telling me?